Cryptocurrency, why now? Well, there's a bunch of things why now. First of all, if you go back, cryptocurrency is a logical extension of the evolution of technology over the last 30 to 40 years. There's nothing particularly untoward about it. During that time, those 30, 40 years, a lot of people have made a lot of money in technology, and there's a significant libertarian bent out there in that community. If you add that to the great crash and the fears of debasement of the currency and all of that kind of stuff that was going on, if you send yourselves back to 2007, 8, 9, and those kinds of fears, there was that community in the technology world saw that and said, we've got to do something about this. In particular, they were concerned about the banks, and they took their libertarian distrust of government and added it in. The third thing, which I actually think is the most important, is that during that time of the development of the internet and all these technologies, we all got used to using cash, using electronic banking and transacting. Go back 20, 30 years, cash was still a thing. Now cash is much less of a thing. The problem we face, and I'm going to be repeating this endlessly this evening, the problem we have is we took an old banking system designed with the institutions, the organizations, the regulations. We took that from the physical world and put it online without ever redesigning it to go online. Cryptocurrency is an attempt to design it to go online. A good thing. During those 30, 40 years, the technology has all changed, particularly on the cryptographic side. The standards evolved. In post-crash, there are a lot of people out there with a lot of money looking for yield. We all know that was a problem in that period. So, sorry, so during that time, money was starting to flow for people towards people who could create yield, and the cryptocurrency market or ecosystem was one of those places. And then finally, not to knock the regulators too much, but I enjoy doing it anyway, there was regulatory confusion. It's one of those things, everybody's pointing to the other person. The United States financial system regulation is Byzantine. And there's goodness knows how many regulators. They've all got their little niche. None of them really focus on cryptocurrency. So there was a big loophole for a lot of innovation to take place and drive through. So that's kind of the background, all of which was taking place in the last 20, 30 years. So we had this perfect storm of events, but the digital cash is not new. The first one was back in 1989. I don't know if any of you can remember the thing called DigiCash. It came out of the woodwork in 1989, right the same year the World Wide Web was invented. All right, it was one of the first things to use that technology, but it went nowhere. So all of those things I was just pointing at must have increased in importance subsequent to 1989, such that in 2008 we invented, or somebody invented, Bitcoin, which was the first crypto. So what is it that crypto is trying to solve? Well, when you take banking online or transacting online, you lose a lot of the properties that are really important in the physical world. We all take for granted. When I go and buy a goat from Derek, I give him the $20. It's a transparent transaction. You can see it. When I'm online, you can't see the person you're buying from. The rules change online. Specifically, security. When I'm at home, I stuff money under my mattress or in the bank. When I'm online, it's in my computer. All sorts of things can go wrong. Igor in Kazakhstan can get at it. So security becomes an issue. Transparency. When I'm dealing with Derek and buying his goat, we can all see what's going on. There's my $20, Derek. Here's your goat. Simple. When you're online, there's no such transparency. We need to find a way of getting transparency into the system. Immutability, lovely word. They love this one. When I buy the goat and walk away, that's the transaction's over. It's done. That's just a one-way thing. Online, things can be undone. You don't know what's going on. I'm buying something from Amazon, or I'm buying something from some foreign country. We don't know easily about the transaction. Double spending. When I'm giving Derek his $20, he can see I'm not giving it to someone else at the same time. Online, I could easily do that. I could trick someone. Say it's the $20, here's the $20, the person gives me the goat first, it wins the prize. You need to solve that problem also. Cost. It's an expensive system. We built a system for physical world, put it online, and all we did was to add a whole bunch of computers and make it even more expensive. So the online system became really expensive. We could reduce that cost. And the role of third parties, this is where the libertarian piece comes in. I'm going to have to keep repeating this, so I apologize. They want to get the third parties out of the system. They want to go, when you're online, you can go me to Derek. I don't need to go through the bank. So let's do that. Cryptocurrencies were specifically designed to answer this set of questions. In other words, it's not just a fad. It's not just something that came out of nowhere. It's answering a very specific technical question. How do you do transacting in a digital environment? And that's it. The banking system was never redesigned when we put it online to take advantage of all the efficiencies that do exist online. Crypto was trying to do that. So what is a cryptocurrency? That's answer to question number one. That's why we're doing this now. This became a problem. We need to solve that problem. What is a cryptocurrency? There's some core principles. All cryptocurrencies they're trustless. We're talking about a whole bunch of, libertarian coders in their caves someplace. They don't like trusting people. All right. So transactions in this world are validated by algorithms, not relying on people or banks or anybody else to do that kind of stuff. It's all done by the computer. It's much more trusted in that sense. It's permissionless. Why? What does that mean? That means anyone can join the game. You can hook your computer. You can go home tonight, hook your computer up, download the Bitcoin software, and become a player in Bitcoin. Nobody has to give you a license. You don't have to get regulatory authority. There's nobody telling you you can't do it. Anybody can do it. And I'm serious about that. Go home tonight, download the Bitcoin thing, and you're a node on the network. You can download the ledger to go with it. I'll explain that in a minute. It's transparent. Remember I said that's a problem online? In the existing world, it's not here. Why is it not here? Because every single transaction that has ever taken place for Bitcoin, you can go and look at. Every single one from day one, you can go and look at them. Anybody who's got the software can go and look at them. Now, that sounds good until you realize what they look like when you do look at them, but that's another question. Censorship resistant. I love this. Censorship resistant. Don't forget who we're talking about doing this. Writing code in their minds is writing a book. If you regulate me, you are censoring me. So censorship resistance, regulation resistance was a very important part of developing the early cryptocurrencies. Decentralized. This is going to be another theme we come back to repeatedly. There is no central ledger. There is no bank with a set of accounts. There is nowhere to go to find out all these accounts. The only ledger exists on your computer at home. That's it. It's a decentralized ledger. We're going to spend a lot of time on that concept. There's no banks, and the government is out of the picture. This is the wild west of currency, okay? But it's designed specifically to solve those issues I mentioned at the beginning. Okay. So what is a cryptocurrency? It's this. Satoshi Nakamoto is the person that wrote the white paper that created Bitcoin, which is the first cryptocurrency. Top of page 2, you will read this. We define an electronic coin as a string of digital signatures. That sounds kind of very Zen-like. What the heck does he mean? A string of digital, that's a coin? That's something valuable and spendable? Well, the analogy is to think about the dollar. What's the dollar? It's a scrubby piece of paper that individually is worth nothing, but somebody accepts it in an act of faith when you give it to him. When I give my $20 to Derek, he's accepting as an act of faith that he can use it and buy something with it. The dollar is simply a series of acts of faith. Crypto is simply a string of digital signatures. In fact, if you think about it for a minute, they've got a better system than the dollar does, because at least you can look at these signatures to check to see if they're real. You can't check the acts of faith for the dollar. It's just that we're so used to it, we don't question what's actually going on when we use it. So if it's a string of something, we need people to look at it, you got to store it somewhere. So now we're going to talk about a suite of things that really make a cryptocurrency. You need a chain of digital signatures. We just said that's what Bitcoin is. It's a chain of digital signatures. You need a place to store it all, and that's what we call the blockchain. The blockchain is a series of it's a distributed ledgers. What do I mean by that? I'm going to explain this in really intense detail. That's where you need your stiff drink. But basically, anybody who logs on to the Bitcoin network, it gets, or could get, because it's drifted a little bit from the original theory, you could download the entire ledger. You could own the ledger, all the accounts, all the history of all the Bitcoin ever on your hard drive at home. That way you can check the provenance of the Bitcoin. Don't forget, what are we doing? We're trying to check the efficacy of that string of digital signatures. It's like trying to get confidence in them. If I'm accepting it for value, I want to know somebody else accepted it for value before. If they did, and several people have, and I can go back through that string and see several people have, I'm confident it's got value for me too. That's the point. So we need it stored somewhere where I can go and check it. Don't forget, we got rid of the banks. So everything in this system is peer-to-peer. That's another critical feature of crypto. We've got rid of the banks, but there's a problem that comes with that. There's nowhere to go if something goes wrong. If you lose your password, there's nowhere to go and say, oh, I forgot my password. Could you let me refresh it? Sorry, you lost your password. That means you lost your Bitcoin. Tough, okay? There's no recourse in this system. It all comes down to cryptography, which is really kind of geeky stuff. And I'm going to bore you with it to death in a minute. But basically, it's a series of different kinds of technologies, all various kinds of algorithms sitting out there in a big black box, a series of black boxes, that makes this whole thing work. They provide us with the digital signatures. They allow us to move them. They allow us to see them. And they hide it all so that you can see only what you need to see, which is that series of Bitcoin going through time, being used repeatedly, raising your confidence in it, and providing that provenance that is so important, okay? That's, if you add these features together, that's really what a cryptocurrency is. It sounds weird, but that's what it is. Let me just take you through the process, because we're going to be talking a lot about the bits of this process. So let's put it in context. Jack is going to send Bitcoin to Jill. Okay, that's our process. He gets on his computer, bang, bang, bang. None of what I'm about to go through he actually does. The computer does it, but we're going to abstract it out for you. Right? He sends his transaction off. I'm sending one Bitcoin to Jill out into the big wide world. It joins a pool of such transactions. There is somebody sitting out there, we're going to get to later, called a miner, who looks at that pool and says, oh, let me gather some together, check them, and add them to the blockchain. That's the process we're going to get to. So his transaction gets scooped up into the block. Once that miner has validated all the transactions in this block, they send it out to everybody on the network, and they have to do a little mathematical solution. They say, yes, that's a good answer. They send it back, and Igor in Kazakhstan, who is our miner of choice this evening, does that, adds it to the blockchain. Now that block of transactions is validated, verified, we've lengthened the string of signatures that Bitcoin is, and Jill gets her money or her Bitcoin. That takes 10 minutes. From beginning step 1 to step 6 takes about 10 minutes. It's designed to take 10 minutes by all the algorithms that are part of the Bitcoin protocol. All right. If it speeds up, it takes 9 minutes, they make it more difficult. If it slows down, they speed it up and make it easier to do. They're obsessed over trying to get this 10-minute interval. Okay, hang on. Trying to go forward when I'm not. There you go. Now, is Bitcoin money? So I'm going to segue here. I'm going to do a little rehearsal of what I've said before on money. Money is an asset that has these 3 attributes. It's a unit of account, which means that in the nation or the economy we're talking about, it's the dollar. In our case, it would be the dollar. We price things in dollar. That's a unit of account. It's a medium of exchange. I think that's pretty self-evident to all of us. And it's a store of value. That is that the 20 bucks I gave Derek for his goat is still worth 20 bucks down the road. It doesn't lose that value too quickly. It's plus or minus. We may have a little inflation, but it's not going to suddenly be 50 bucks. All right. Where does it come from? I'm doing this because we'll find out where Bitcoin come from later. 20% of the money, 20% of dollars in the world come from the central government. How do they create those dollars? They buy assets from the private sector. All right. So Fed gets on the phone, dials up Citibank. I want $2 billion of bonds. No problem. Figure the price. Citibank sends the Fed the bonds. Someone at the Fed does this. Bing, out of nowhere comes $2 billion. Just made up. There's no other way of describing it. It's just made up. It's magic. It's wonderful. Good job if you can get it. The other 80% of money in our economy comes from the private banks. Most people don't realize this. It's the private banks who make most of the money in the United States. Okay, 80% of that money, and they make it when they give you a loan. When you go to Bank of Bennington and ask for a mortgage, they don't run down, look in a drawer and say, "Oh, I got the money, you can have the mortgage." They don't. They just invent it. They say, "Oh yeah, you're going to pay me back." Punch the computer, in goes the money into your checking account. Out of nowhere comes the money. It's made up. So 20% is made up by the government. 80% is made up by the private banks. That has some ramifications for monetary policy, which I just thought I'd add in as a diversion today because it's topical, because we've just heard that the Fed is scaling back on its purchases of bonds. That means it's slowing down its creation of money. So it can do that, create money directly, when it normally tries to influence the creation of money by making the economy either more risky or less risky, which it does by raising or lowering interest rates. If you raise rates, you make the economy more risky, the banks are less likely to lend, they create less money, and vice versa. So that's where money comes from. So given that, is crypto really a money? No, because it's not a unit of account anywhere. All right, it's not there yet. Now, whether it gets there is another question, but it's not there yet. So we should not look at crypto as a money. We should look at it as a risk-based, it's a risk asset that you can own and put in a portfolio like any other asset. Okay. Get that drink, guys. This is where we go into the dark arts. There are 5 real major components of cryptography involved in this process. And I'm going to skip over the surface. I guarantee you won't feel that way. You're going to get a headache through this. Public-private keys, that's how you establish the signatures. Public-private, it's a public-private key. There's a pair of keys, one public, one private. Think in terms of username, password, kind of a separation of the two. In this world, your username, the public key, everyone gets to know. The private key, no one gets to know. And as I said, if you lose it, tough. Next, hash functions. Oh my goodness. If you look at conversations about the size of the network, one of the things they talk about is the hash rate. What on earth are they doing? Well, hashing is a mathematical process where you essentially disguise stuff. You take a transaction, you hash it This sounds a terrible process, doesn't it? It's only chopping something up, right? And out comes some totally incomprehensible gobbledygook that you can't backward engineer to find out what the original transaction was. The whole point is to provide anonymity and security, two of the issues that we said that we're trying to solve with cryptocurrency. Merkle trees, oh, Mr. Merkle, goodness. That's got to do with how we store hashes. We'll talk about the distributed ledger, and we'll talk about the proof of work. Proof of work is the really funky part of this. That's the fun part, okay? And parenthetically, that's where all the energy is spent that you read the Bitcoin consumes. It's that bit at the end. So let's go through this. Public key cryptography. Remember, Jack this is all done by a computer. Jack, none of this does Jack actually do, but I'm going to say he does it, right? Jack is trying to sell money, send Bitcoin to Jill, right? So what he does, his computer, his digital wallet, goes and says, give me a private key and match it with a public key. Private key is the red one. Public key is the blue one. Now he's got a public key. The black box has sent back something. He sends that to Jill. Oh, GMALL 123 is going to send me something. That's really interesting, right? Okay. Then he attaches his message. I'm sending 1 Bitcoin to Jill. That's the message. That's that little message box, plus his private key. And he sends that back to the black box. Black box dutifully spits out a signature. Aha! A digital signature that we're looking at as the provenance for the transactions in the Bitcoin. He then attaches that signature to his message. I'm sending you 1 Bitcoin, sends it to Jill. She then has to verify this. So she sends all of that stuff back, the message, he's sending me a Bitcoin, the signature, and the public key, sends it back to the black box, and the black box says, you're lucky. Yes, that's a valid signature. That is a good part of the string of signatures. You are indeed getting that 1 Bitcoin. Jack is entitled to send it to you because he has it, and you are entitled to receive it because you've got a valid address. That's what's going on here, right? And it provides complete security. Hash functions. I didn't think I was going to get into this, but I'm going to have to. Alphanumeric, we're in computer land now, guys. We're talking about alphanumeric strings. Fascinating. What's an alphanumeric string? 1 + 1 = 2. That's an alphanumeric. Or the complete text of War and Peace. That's also an alphanumeric string. They're very different lengths, okay? You shove them through this black box called a cryptographic hash function, and out pops something that is very weird. It's fixed length, and it's gobbledygook. You've seen this kind of gobbledygook. If you ask a computer to give you a password, your recommended password, you see all these weird uppercase, lowercase numbers, dashes, and all that kind of stuff. That's kind of the same stuff you'd get out of a hash function, right? But it's a fixed length. If you're looking at that, you don't know if it's War and Peace or if it's 1 + 1 = 2. You can't tell. It's part of adding security to the whole digital signature. Okay, it's a really, really important part. Here's a message, Bob and Nancy. Shove it through the cryptography. Out comes this thing, something like that. I made this one up. All right, we didn't really generate this one. It's too short for one thing, but it's illustrative. Shows you what it is. What happens if I lengthen the string? They went for a long walk. I had it, shove it through, and you get a totally different message, but it's same length. Okay. What happens if I make a mistake? I do this all the time when I'm texting my kids. I'm forever punching I and not O. My kids call it daddy's fake. Finger problem. I've changed it. I've got one little spelling error here. And out comes a totally different hash. It's not a little different. It's totally different. If you drop a comma from War and Peace, you will generate a completely different hash. Anyone looking at that second one knows somebody's tampered with this. It's not a valid digital signature to add to our string. Kick it out. This is all part of that process of providing security and so forth. The problem is if you've got millions of these things floating around and you are trying to store them on your computer, you want to economize on computer space. You want to scrunch this stuff together, create space. Mr. Merkle, goodness knows, out of Stanford, came up with this really sensible idea. We're going to have 4 transactions in our little box, right? Transaction 1, get a hash. Transaction 2, hash. Aha, he said. I'm going to create a hash of hashes. Told you hashing was important, right? And we do that the same over here, and you know where this is going because it's called a tree, right? You arrive at the top of this tree and you get one hash that now encompasses all the information of all 4 transactions. And good luck trying to backward engineer what any of those transactions look like. It's gone, done. This is a really good way. This is classic cryptography way of disguising something. But more to the point, I'm only storing 1, not 4. So I've economized on computer space. Same thing over here. What happens if Igor, nasty devil that he is, mucks around with transaction number 4? It becomes transaction number 5. We hash it. It goes all the way up. But now, because there's a change, all the hashes have changed. We throw that whole bunch out. We know that's contaminated stuff. Right? In the public consensus process, if I received this and I'd seen that original hash, now I'm looking at the new hash, something's changed. Now, I don't know which of these transactions is being changed, but it's being changed. So we toss it out. Somebody has to start again. I told you, this was really, really stiff drink time. There we go. Now let's talk about ledgers, which at least is a little more comprehensible. In the traditional system, let's go through that first. To get money from Jack to Jill, there's a whole bunch of stuff involved. It's got to go to the bank. It's got to go to the payment system. Every bank maintains its own ledger. And goodness knows they don't like looking at each other. You try. Go from one bank to the other. Oh, let me look at your chart of accounts. No, thank you. It's private, proprietary stuff. Money moves from bank to bank via the payment system. The banks do all the heavy lifting because they're the ones on the hook for getting this wrong. They're charging a good fee for it, and Jamie Dimon needs a big bonus. So this is expensive stuff. Transactions take time to be cleared. Well, when you go and swipe your debit card in the supermarket, it feels like you've just done the whole thing, but you haven't. All that happens is that the card sends a message back to HQ and says, do you have the money to buy this stuff? And it says, yes. It's just a clarification that you've got the money. No money has moved. You walk out with the goods and the supermarket hasn't got the money. That takes place a few hours later, and it takes place in a batch process. It feels like you instantaneous, but it's not instantaneous. It takes a long time. Transactions can be reversed. Oh, I sent the money to Jill. I meant to send it to Alice. Could you help claw that back and move it? Or on the credit card side, that's not me. Somebody else did that. Change it, right? So there are ways of changing transactions. Transactions, if you're going to change them, can't be anonymous. I need to know that you actually, I need to know Jill, and I need to know Jack, and I need to know Alice in our little illustration. It's not anonymous. You are known to the banks. The process is costly. There's a lot of people involved in doing this, a lot of bricks and mortar, plus Jamie's bonus. Now, the real cost is if you want to send money abroad. If let's say you're a migrant worker and you want to send money back home, not only do you have to go through the hassle of sending it through the American bank clearing system, but it has to go through the Filipino clearing system and maybe a clearing system in between. It takes forever to get there, and everybody's taking their slice of a fee. It's expensive. Traditional banking online is expensive. Transactions are batched and moved around, and they're secure in that sense, but no transaction is encrypted. Only in the crypto world do we get that. And I say this with a certain amount of personal experience, hacking a single ledger is relatively easy to do. I had some people working for me who did that. Okay. This is the new world, the crypto world. It's a distributed ledger. I'm assuming you notice there's no banks on this one. Don't forget, our goal is to get rid of banks. So how does this all work? Every one of these green things on the screen here is a ledger. Every node on that network has the same ledger. I'm trying to bang that message home. This is a transparent system. Everybody sees everything. It's not quite true. As the system evolves, we've got bigger nodes on the network now that do this and lesser nodes, and you and I would probably be a lesser node tethered to a larger node, but the principle remains the same. There are a lot of people looking at these ledgers. So every node has exactly the same ledger. We're all looking at the same stuff. We're all looking to check that string of digital signatures is a good one. We need to know the provenance of every single Bitcoin there. Money moves from peer to peer without a central system. This money really does go from Jack to Jill. Transactions are verified collectively. I described that a little earlier. When the batch goes out to the network, the batch returns and says, yes, it does a little mathematical problem, and it sends back, yes, that batch of transactions is a good batch. It's done collectively. 51% of all the nodes on the network have to agree that that batch is a good batch. If they do, it's appended to the blockchain. That's how it works. Transactions are timestamps and are relatively quick. Now, it takes 10 minutes. I just said that. And they try to make it take 10 minutes. So that feels slow compared to the system I just described run by the existing system, right? But the clever part in the existing system is the banks have separated moving the money from the actual transaction. So they do the moving of the money in the background. In the Bitcoin process and the crypto world, because there's no bank, it's all done all at the same time. So it feels slow, but it's actually quick compared to the existing system. They can't be changed. Sorry, guys, if you push the wrong button and send the money to the wrong person, it goes to the wrong person. And you're relying on that wrong person to give it back to you. You can, and that's happened several times. You may have read recently, there's a company with a little bit of a software glitch, send out $90 million of Bitcoin to all the wrong people, and it had to try to pull them back. Okay. And in that case, it did. And the guy sent out an email, whoops, didn't mean to do that. And everyone kindly gave the money back. But what happens if Igor in Kazakhstan are all the people to give it to? He's not giving it back. He lost it. Transactions are anonymous, another one of our goals. This encryption gets us there. Process is relatively cheap, especially cross-border. Why? Because there are no borders. This is a computer network. There are no borders. Of course it's cheap across borders. There aren't any. It's the way it is. It is a cheap way of doing this. This is really important in developing nations. It's why you see cryptocurrencies being adopted or talked about a lot in developing nations. This is a very attractive feature for them. I've mentioned this, and hacking this is practically impossible. Comes back to what I said a few minutes ago. 51% of everyone on this network has to agree that that's a valid transaction. If you want to change a transaction, you've got to get 51% of all the nodes on this network to agree simultaneously that the new transaction, not the old one, is the correct one. That's a lot of computers you've got to hack simultaneously. You're not likely to be able to pull that off. It's theoretically possible. From a practical point of view, it's impossible. So now let's get to the really funky stuff, because I've told you the one big problem with this is we've taken the banks out. So who's going to do the work? And she's like, okay, whoops, we've created this communal process and we're relying on the work to get done, but who's actually going to do the work? We need people volunteering. So proof of work is the solution to that. Proof of work is something that was invented to try to foil spam emails. Didn't do too good a work, but it works if you apply it. You have to expend computer power to be allowed to add blocks or transactions to the blockchain. And proof of work is not actually doing the verification of the transactions. There's another step involved. It's solving an intensely difficult mathematical problem. It's like you do all the work. I've assembled the transactions. I've checked the signatures. This is all good to go. I want to add to the blockchain. And you're telling me I've got to do what? I got to solve a mathematical problem? Okay. But the point is, if you're the first person to do that, and don't forget, there's a lot of miners around the world trying to do this, you're allowed to add the block to the blockchain, and you get Bitcoin as a reward. This is where Bitcoin comes from. This is where Bitcoin gets created. In our system, it gets created when people make loans. In this system, the Bitcoin gets created when people do this work, solving these mathematical problems. Magic on the one hand, magic on the other, but at least there's hard work involved here. Let me take a look at it in detail. So you're a miner, you're sitting out there. There's this big pool of transactions, including Jacks. It's sitting out there. If you go home and log in to the right website, you can watch the transactions come up on your screen as they arrive in the pool. This, as I said, this is public. All those transactions, you can watch them scroll up your screen and look at them. And you know that there's 5 Bitcoin here and half a Bitcoin there. You can see it all. You're a miner, though. You select a whole bunch of these, and you're choosy about the way you go about it. Each block is around 2,000 transactions. You verify the signatures, check with the black box. Are they okay? Yes, they're all good. And then you do all of that hashing I was talking about a few minutes ago. You hash every single one of them, and you come up with your merkle root, which I described to you. Okay? Now imagine yourself. You're sitting there. I've got a set of transactions, real stuff, real transactions. And as a consequence of doing all my hashing of that, I've got a hash sitting here. But I'm not allowed to add it to the blockchain yet. I've got to do this problem. I now consult the oracle of Bitcoin, the software, and I say, okay, how do I go about doing this? It says, well, your hash that you've just created has to be equal to this one, and it creates a target hash for you. And that target hash depends on the degree of difficulty. I knew you were going to glaze over, okay? This is intense stuff, but this is how it works, and this is why crypto is crypto. So now I've got this target, and that target is established by the degree of difficulty, and the degree of difficulty is established by the number of people trying to do this at any one point in time. It increases through time, about every 2 weeks. So now I've got this. I look at my hash and I've got my target, and it's almost infinitely certain that that one is a bigger number than this one, but it's got to be smaller. How on earth do I do that? Well, some genius saw this. I add a random number to it and I run it through the black box again. Okay? And that gives me a new hash. Wow. This is all hashing, right? I now compare this one I've just generated to the target. Okay. And if it's more, I have to go and do it again. If it's more, I do it again. And the only thing I can change is not the hash of the data. That's set. It's real stuff. The only thing I can change is the random number. So I've got my computer sweating at the brow, randomly generating numbers, trying like crazy to come up with a number smaller than the target number. Got it? When it does, the bells and whistles go off. I've got what they call the golden hash. Yes, I can add this thing to the blockchain. But before I do that, I've got to get everyone else to check my arithmetic. So I send it all out. You remember I said you send it all out to the, and the arithmetic they do is they take your data hash, your random number, degree of difficulty, they run it through the box, and it comes up with the answer you gave them. They say, yes, those transactions, those signatures are valid. Add them to the blockchain. That's how it gets to the blockchain. And it's that process that takes all that electricity that we talk about. It's not computing the numbers. It's not signing the signatures. It's the actual process of trying to do that computation, that random number search that chews up all that electricity. It's really hard for people to get their head around that. You would think it's maintaining the data, but it's not. It's doing the mathematical problem that chews up all the electricity. Now, you think I've been kidding you, all right? Now, I've also told you that you can go home and look at all of this stuff. This is what a blockchain block looks like if you put it on your computer. And the first thing you see is the hash that identifies it, right? You would see this on your computer. You can go home and check this exact block. Right? Next thing you see is confirmations. What do we mean by that? We're talking about the provenance of Bitcoin. Every time it is confirmed as having been used and valid, it becomes stronger in the community's eyes. It's a good Bitcoin. Somebody's used this one a few times. I can use it. I'm building confidence. So the more confirmations you get, the better off we are. So we accumulate confirmations. Timestamp, this block was generated in 2017. Its height, think kitty blocks, block number 1, 2, 3, 4, 5, height. This is block number 500,312. It's a real block. It was mined by these guys. They tell you, and if you look at this on the screen, this is what it looked like. Next thing you see is it's got 2,580 transactions in it. It's a big block. Next thing you see is this absurd number. This is the difficulty that they got when they had to go and compute that problem. This, I told you, it's a real thing. This is the Merkle root. This odd-looking thing encompasses all the information of 2,580 transactions. Good luck trying to figure out what they are. Okay? All right? Down here, we have something called the nonce. I forgot to tell you, that's the random number that BTC had to choose to put into the computer to come up with that hash at the top that is the successful hash that identifies this block. I left out a couple of things. You would see a couple more things like the version of the software they're running. Down here, you get to the nuts and bolts. 10,837 Bitcoin were moved in this block, right? And their block reward was 12.5. Not bad for 10 minutes walk. It's about what, $780,000? Pretty good. Pretty good if you can do it. Go home, get your computer set up, and become a miner. Good luck. All right. But what's this funky thing at the bottom? They also got a fee. I thought they were only getting money for doing the proof of work. Well, a funny thing happened. You see, not all transactions are the same. If you put your transaction into this great big pool and the miners are looking at it, they're after this 12.5. They want to be as quick as they possibly can because they want to solve that problem and get the 12.5 by adding to the blockchain, right? Sounds easy, but what happens if you think you've got a funky looking transaction that may take up a little more computer space than somebody else's? So what you do is you go to Igor and say, hey, look, listen, I'll give you $50. Put me at the top of the line, okay? So that's where the fee comes from. It's becoming more and more of a fee-based system. People are realizing that if you're going to get your transaction through fast enough, you're going to have to juice it. So that the miners will put your transaction into any block that they're doing. So that's what you would see. I mean, I can't emphasize this enough. You can go home and look at this block. You can see this. You know what's going on. It's all about confirming the provenance of that string of digital signatures. That's what the whole thing's about. Now, what does an actual transaction look like? If you scroll down on your screen, you would start seeing transactions. This is what one looks like. Good luck understanding it. There's the person who sent it, that gobbledygook. It's the person they sent it to, that other gobbledygook. And there's the hash of it. And you know when it happened, and you know how much was sent. But that's all you ever know. But you do know that that particular Bitcoin moved from A to B. So if you're trying to pull on the string and see if that Bitcoin's a good one, you can go and do that. You can go back to prior transactions. You can check. You can see these are actually clickable. So you can click on that address and see their previous transactions in other blocks. It's a wonderful system. It's entirely transparent. There is nobody hiding anything from anyone, except when you actually get to it, that's what you look at. It's very, very disguised. That's why hashes are central. All right, enough. That's what makes crypto crypto. You can all take a deep breath. And I thought I'd give you an easy chart next, just so you can take that deep breath. This is the price of Bitcoin. If that's not a bubble, I don't know what is. There's something funky going on. And I think that what goes up with that kind of intensity tends to come back with that kind of intensity at some point. Now, there are all sorts of reasons for that. I've smoothed it dramatically. As the line goes up, it's actually very bumpy month to month. I just did January and June numbers just to smooth it out. But you can see that there's been an enormous increase in interest, an enormous increase of activity on the retail side in particular. People are piling in on Bitcoin, and that's driving the price up. One of the things we all have to remember is Bitcoin is a fixed thing. There's only ever going to be 21 million of them. That's it. There's never going to be 22 million of them. There's 21 million ever. They did that because they're a bunch of libertarians. They're worried about debasing the currency. We're not going to create an inflationary currency. Okay? We've already got to about 18.9 million. So there's not many to go. But because they're changing the rate of reward, it will take a long time to get 21 million. But when we're at 21 million, that's it. That's all the Bitcoin. And then supply and demand is going to take over for the price. Size of the market. Here are the top 15 cryptocurrencies. You can see Bitcoin is by far the largest. That's why everyone talks about Bitcoin. But there are a whole bunch of others. Ether on the Ethereum network is the second largest. Ethereum blockchain is actually quite an interesting one because it allows other people to use it. It generates tokens other than just its own. Its own is called Ether. That's where the valuation of that. And you can see that when you get down to even the 15th, there's practically there's nothing there. These are thin markets, very thin markets. It doesn't take a lot of actors in one of these markets to shift the price, okay? And estimates are that in the Bitcoin market, there's about 1,000 people with enough Bitcoin to move the market. So it's an interesting game to play. Over here, let's compare it to some other markets that you may be interested in or investing in. There's the US government bond market, stock market, NASDAQ, money supply. And then you see global crypto at the bottom. That's global crypto. If I had put global stock markets, the lines would be off there and you wouldn't even see the crypto when I put it on the chart. Even with all this hype, it's a small market. Even with all this hype. Keep that in perspective. There are much larger, much deeper asset pools than crypto. So if you're playing in crypto, you're playing in a small market. Pros and cons, I think, I think there are some really significant pros. First off is that we've created kind of a digital currency that you can use for innovation. It's useful. If you're doing a digital thing, you can raise digital money to do your digital thing. I think that's a very useful thing. There are lots of innovation going on, and it is fueled by people using online coin. It's lower cost than our existing system. Remember, the problem we're trying to solve. We took a system designed for the physical world and just shoved it into computers. We never redesigned it for the computer world. We never did that. We didn't lower the costs because we didn't do that. This tries to do that. Peer-to-peer finance, I think, is interesting future. Cut out the middleman. Who needs the banks? This is all online. I don't need them. Why if I can do my transacting without a bank and lower the cost, okay, let me do that. Inclusivity is a very fashionable word right now, but it's a very important one. You will hear a lot of crypto people talking about democratizing finance. You may have seen that phrase used. Democratizing finance is important, particularly in the developing world. And I'm going to show you Nigeria in a few minutes. In Nigeria, less than half of the population has a bank account, and 95% of all transactions are still done in cash. But more people have a smartphone than have a bank account. So it makes sense to have a digital currency that they can access on their smartphone. So cryptocurrencies are really, really attractive in developing nations who have that problem. It's not such a problem for us because we have a highly developed banking system, financial system. But in countries where that doesn't exist, crypto is an advantage and has the tremendous advantage of bringing people into the economy and making them members of the economy. Anonymity, if you're into anonymity, that's a pro. Proof of concept, we know blockchains work. I'm going to talk about the downs in a minute. And my favorite, of course, we can break up the big banks. Our regulators failed to do that. And as a result, we have a very high cost banking system. Yeah, Jamie Dimon's bonus is a big deal. But we can break up the cartel just by issuing digital currencies. Just take them out of the picture. It's magic. It's wonderful. This is my favorite part, by the way. Okay, cons. It's not got much potential for money. Think about the number of transactions. I did a little, I took one of the slides I took out. I told you I took some out. One of the slides I took a look at recent blocks and averaged them out. It's about 1,800 transactions per block. That takes about 10 minutes. That's about 3.1 transactions per second. Okay. Visa by comparison, does 1,700 transactions per second. If I'm going to ramp up a blockchain to do that, I'm going to have a whole wad load of miners, and just imagine the electricity we're going to be using to catch up with Visa. And that's just Visa. If I add in MasterCard, Discover, whatever, I add in all the debit cards and so on. The number of transactions going through the regular system vastly outweigh the number of transactions going through a crypto system. And there's no way of scaling up. You also have the problem of valuation. Why am I going to use this as a currency and I get paid in Bitcoin, let's say, and last month, I got one Bitcoin, it was $10,000. This week, I get one Bitcoin, it's $60,000. How did that happen? It's like it's not valuable as a currency with that kind of gyration. You need some stability and predictability. Difficult to scale at high volume. That's what I was talking about. And I got these out of order. Just think of the environmental damage. If you tried to scale this thing up, it's already using more electricity than Switzerland in a year. And if we tried to scale it up so that, let's say, it could become the currency of the United States, we'd be using more electricity than the United States. All right? It just doesn't work. Something has to give here. And it's the proof of work that I told you, that little puzzle. If you get rid of that and substitute a different way of proving your worth in the system, and they're trying to do that, then you could deal with the environmental damage. The other thing is, what I haven't mentioned at all, is fraud. All this anonymity, all this nice stuff, it's great for money laundering. It's terrific because you saw the address in that transaction. Good luck knowing if that's a good one or not. And there's no way of backward engineering to find out. It's a wonderful system for fraud and illegal activity. Now, having said that, I've seen research that says only 3% of transactions are fraudulent, and I've also seen research that says 40% of transactions are fraudulent. Who knows? But clearly something's going on. Otherwise, why every time there's ransomware pop up, do they want you to send a Bitcoin? It's a neat way of avoiding being caught. And there's too much choice. There's just too many of these. You want to lower the cost of the system. You're actually raising the cost of the system by proliferation. Every time I want to change from Ether to Bitcoin, somebody's got to act as a middleman. I wanted to get rid of middlemen. Now, all of a sudden, there are exchanges all over the place that allow me to do this. I'm reintroducing into the system the very thing I wanted to get rid of by proliferation. I made it too easy. All right. What happens next? This is the last of our 4 questions. What happens next? So we've talked about why now, we've talked about what it is, and we've talked about the crypto part. What's next? It's weird what's next, really is. The underlying technology is more interesting than cryptocurrencies themselves. I think that's pretty clear at this point. Blockchain finance can really deal with cost and bringing people into the system. I think that's a really valuable socially going forward. Yes, TradFi is a thing. I just thought I'd throw it at you. TradFi is absolutely a thing. Traditional finance can be radically altered because so much of it is easily programmable on a blockchain. It's easily programmable on a blockchain. Contracts, insurance policies, lending, retirement accounts, brokerage, fundraising, securitization, even organization itself can all be done on a blockchain. I don't need a bank. I don't need an insurance company. I don't need any of those things. I can do it all by algorithm on a blockchain with a contract. The future of banking looks pretty bleak when you look at it this way. The future of finance generally is going to get turned upside down, which is why Jamie Dimon says Bitcoin is rubbish. He doesn't want it to get anywhere. And he keeps buying up startups to make sure they sit in the corner and don't do too much. Let me give you some examples. Initial coin offerings, I hope some of you may have come across an initial coin offering. You know that when you sell your startup into the public, it's an initial public offering, right? That involves a whole bunch of $2,000 an hour lawyers. I've seen them. They check for spelling errors and they charge you $2,000 an hour. It's useless, right? Accountants, lawyers, all that kind of stuff. In this world, I don't need that because it's peer-to-peer. I can go to you and say, listen, I've got this great idea. Give me some money. I'll start it up. And in return, I'll give you a token on my blockchain. You can use that token to redeem it against a product. Maybe I'm going to make woolen socks, and you can come and get a pair of socks down the road when I ever get to it. Or you can go and take this token and sell it in the secondary market, one of those exchanges I was just telling you about, and buy some Bitcoin with it, right? So I can tokenize in the jargon. Now, the problem with it, all of those expensive lawyers and the government actually add value because they put a barrier between the startup and the public, and they ensure that there's some validity to what that person's doing. There have been ICOs where someone's got some money and basically disappeared. It was fraud right up front, and there's no way of knowing in this system, don't forget. So next one, lending, peer-to-peer lending. It's also a thing. It's going on. Some of it is really weird, something called flash lending. Microseconds. I give you a loan and you pay me in seconds. Why on earth would you do that? You're closing a deal, you're a little short, you need a few bucks. I give you the bucks. The minute you close on your computer, you send the money back. Literally seconds. Flash lending, it's a thing. It's really strange stuff. Again, I keep telling you, the banks are at it. Now, the other thing, of course, with these high valuations, if you package it correctly, you can get good yields. So this is attractive to people who are looking for yield, higher yields than you would get in a normal banking system. So people are beginning to try to figure out how to do blockchain-based lending. Crypto investing. I don't know if you follow well, I hope you've got better things to do than read the Financial Times every day or something. But anyway, the SEC just sanctioned an ETF that was based on Bitcoin futures. Then a week later, it turned down an ETF that was based on Bitcoin spot markets. Let me unravel that a little bit. The reason the SEC allowed the futures one to go through is because it can point the finger at the person who's monitoring the futures market. There's actually a regulator of futures markets. There is no regulator of the spot Bitcoin market. So the SEC doesn't feel comfortable with an ETF based on that because the SEC's job is to protect retail investors. And it's saying, until there's a regulator here looking at it, I can't sanction that. So it gets a little complicated. Staking, won't get into that too much. It's basically investing, but you put your Bitcoin in and you get a return on it. And it's useful for mining. Non-fungible tokens. I'm sure you've all heard about this one. This is the purpose of a non-fungible token is to get around the problem that the internet created, which is where everything can get copied and sent everywhere. If you're a writer or somebody, an artist of some form, they write a piece of music and you put it on the internet, next thing you know, everybody's listening to it and you've got no income. But if you use all of this encryption stuff I've been talking about, and if you put it on a blockchain, you can identify it precisely. You in economist speak, you make it scarce. It has value all of a sudden. Somebody's going to have to pay you for it if they want to own it. And you've seen some really weird transactions taking place. The Economist did a good one. They had the cover when they did a whole set of articles on crypto. They had a little crypto front page. They sold it for $400,000 as an NFT. So somebody somewhere has got a little digital version of the front cover of the. I'll sell you mine for $300,000. Okay, that's as simple as that. Stable coins. There's another problem we've talked about. The volatility of prices of these various cryptocurrencies means that they're not very good at tokens. This token, is it worth $100 or is it worth $1,000? It changes. So some bright spark says, well, we like the idea of tokens because that's how we can spend money in our little ecosystem. But we're going to make the value stable. And how are we going to make the value stable? We're going to tie it to assets that exist in the non-digital world. Commercial paper, something like that. So you've got a token backed by something that we would all recognize as a very traditional asset. The only problem about that is if everybody in the crypto world says, I need to turn in my tokens because I think you're going out of business, and the person who's issued the token has to start liquidating their assets to pay people off, you could create technically a run on the bank, and all of a sudden the run in the digital world becomes a run in the physical world. And since there's no regulator to control this, that's a problem to the central banks. They don't like that. And then my particular favorite, anyone that's worked in a very large organization realizes that pretty much the top of the house is useless, right? They're all running around having big important meetings, flying around in jets, talking to each other and doing important stuff. It's like the Politburo in Moscow, it's like central planning committees, all that kind of stuff. We can get rid of that. We can do this peer-to-peer. We can actually have an organization that doesn't need a CEO. What a wonderful idea. I like this particular idea. I started out my life studying the theory of the firm. This is like the logical conclusion of that. But there are a couple of these. Is it going to be a thing? I don't know. I don't think it's going to be a thing. So there's some examples of what happens next. Now, the problem about this is tomorrow I could put two more on here. There's money flooding into this. Just this week, an organization in San Francisco raised $3 billion to fund things like this. And it's the second one this month. Its money is flooding in as people try to figure out how to change the financial system and rejig it so that we don't have this jerry-rig thing that we lifted from the physical world and put online. There's a lot of money being going in. And if those of you hark back to the 1990s and the dot-com boom, 90% of those businesses failed. You can't even remember the names. But the ones you remember, Amazon, Google, the ones that made it big. We're going to have the same thing here. I can't tell you any of these are going to work, but sure as heck some of them are. And they're going to be really big at some point, but nobody knows which one. So I'm going to, right at the end now. I think this is the next big thing. The problem is, all of what I've been saying, there's all this loosey-goosey stuff going on, and the traditional regulatory system is designed to deal with traditional finance. None of this is really well regulated. And the regulators are really concerned about that. So they're like, okay, how do I rein this whole thing in? In particular, the central banks have a problem because they're trying to do monetary policy when it looks like money's getting out of control, right? And they also have spent a lot of time in the last years internationally putting together ways of controlling fraud. And fraud is booming, if you read some of the reports, in crypto. So what's the solution? Well, the central bank would issue its own digital wallet, right? That's what it is. You get a little program on your computer and it's called a digital wallet because we need to have an analogy that you can all recognize. It's a piece of code that sits on your computer, right? And that's where you store your Bitcoin. That's where you store your stuff. But in the future, you won't store your Bitcoin there. You're going to store your US digital dollar there, all right? If they get to do it. And the interesting thing from my point of view is that bottom point. I told you right back in at the beginning, 80% of the money in this country is created by the banks. 0% would be created by the banks under this system. It removes the banks from the banking system, which is kind of an interesting political challenge. Who's getting on with this? Well, naturally, the Chinese are getting on with it because they seem to be getting on with everything. They've actually got a central bank currency out in trial. They are being clever, though. They haven't removed the banks. What they've done is kind of an Obamacare thing, where Obamacare kept the private insurance companies in, didn't get rid of them. In China, they're issuing the currency and they're keeping the banks as part of the process. The banks are doing some of the processing. The UK and Sweden are looking at this. The Swedes have a target date to go completely cashless. They're probably going to be the first country that achieves that. Bahamas has a sand coin. Yes, you probably have not heard of it. It's probably not worth too much, but it exists. The Eurozone is committed. I like the Eurozone because it's always committed to things. It has communiques, it has protocols, it has summit meetings, and then it'll have another communique and so on. Eventually, it will get there. There will be a digital euro. But in the meantime, the French have gone off and done a little test run of their own. Now, you may also hear that places like Zimbabwe are, and I'm going to show you next, Nigeria is. Countries are really playing with this. So I think of all the things that we can see in the future, this is it. But wow, what a problem it's going to be. What does this mean for the banks? They're out of the system that they're central to. And what about government surveillance? If the Federal Reserve Board is where you've got your bank account, essentially, the Federal Reserve Board kind of knows what you're doing with that account. So that's an interesting problem. People are worried about surveillance. And are central banks overseers and regulators, or are they actually bankers? It's a new role for them. They've got to get used to that idea. So I think it's more likely to be the Chinese system, the hybrid, where there's a central bank currency, but the private system still somehow plays a role. But I will, as I said, almost guarantee you we're going to get there at some point. Let me show you a little bit why. This is the Nigerian. The reason this is important, because they actually tell you why they did it. Lowering transaction costs. We've talked about that endlessly. Boosting cross-border flows. They've got a lot of people living abroad. They want the money coming back to their local economy. They want to make it easy. A digital currency makes it easy. Bringing more people into the financial system, inclusivity. So I mentioned that earlier also. It really works. But this is the interesting one, I think, for the United States. It allows for more targeted social and welfare spending. If everybody's got a digital wallet, think what happened in the pandemic. They had to splurge a lot of money through the system. A lot of it went to the wrong places. Why? Because we have no system for splurging money through the economy. They had to rely on banks, and the banks look after people that are our customers. So yeah, you could get some money. I don't know if it's right, but you got the money. Nobody's checking. It just goes. In this system, I put the money in the wallet, and the next morning, the stimulus is right there. It's done. I know exactly who got the money, and I eliminate fraud. I make it simple. I make it cheap. You could lower the cost of running the safety net. You could do all of your welfare spending through this process. You could really make it cheap and efficient and targeted. And that's what makes it really interesting for a lot of industrial nations or more advanced nations. This is what's really attracting the attention of people discussing it. Interesting problem. All right, we got to the end, guys. We answered the questions. Cryptomania, why now? Because there's a problem to solve. And crypto tries to solve that problem. We lifted an old system, put it onto computers, but we never redesigned it to be on computers. And there's some issues with that. 2, what is it? It's a string of digital. It's Zen. Get your Zen thing going. But then again, the dollar is just an act of faith. What makes crypto? All that boring stuff. Hashes, merkle trees, all that nonsense. What happens next? Who knows? But I almost guarantee you central bank digital currency is part of it. Who knows? Cryptocurrencies are not money. They are risk assets. They're uncorrelated, so they fit in a portfolio somewhere. Technology looks really promising. It's here to stay, guys. We are living in a digital world. It's going to be a crypto world in some form. We may not call it crypto, but it's going to be digital in some form or another. And all of the institutions that we grew up with and got used to in finance are wrong. They're going to be changed at some point. It's going to be an interesting time. Thank you, guys.
Can you just talk a bit about how the government got to claw back the ransom of cryptocurrencies?
Yeah.
It's supposed to be so safe. It wasn't safe for the...
Because the answer to that question is simply that it's really pseudo-anonymous, not anonymous. On my chart, I skated past it. If you're going to turn your Bitcoin into something else, like a Maserati in Kiev, right? You need to get it out of the system. And that moment, you can jeopardize your identity. So you can trace these things. It is possible to, you can go on and see where the Bitcoin's going. You don't know who it is. So when it arrives somewhere, you know it's arrived. And you wait and see if they do something with it. And it's basically the process. That's basically the process. It's not purely anonymous because at some point you've got to touch something else. And the minute you touch something else, you give up your anonymity.
How do Bitcoin fees compare to bank fees?
Lower. In a word, they are lower. Now, if you go on to one of these sites where, as I said, you can go on and you can see every single transaction that's flooding online at any moment in time. You can follow it. It's like get your popcorn out, sit back in your armchair, watch the transactions arriving. Because you can't understand the thing because it's all these strange gobbledygook hash things, but you can watch it. At the bottom of that page, they will show you what the current fees are. And they do it by high, medium, and low. So if you want to juice and get to the top of the line, you know you have to pay this. So the difference between the banking system and the crypto system is that the fees in the crypto system are set real time by supply and demand. It's like surge pricing for those of you who understand what surge pricing is in Uber. So if there's a slack time for the miners and there's not a lot of activity, they'll scoop up every transaction. If it's a really busy time and there's lots of transactions, they'll be picky and you'll need to jack up your fee. So the fees are set in real-time supply and demand. In the banking system, they're set, and believe me, I've done this, they are set because you've got profit goals to meet, and that's very static. It's not supply and demand at all. All right, so there's a totally different metric. So that's the difference between them. On average, the Bitcoin fees are lower.
What happens to your transaction if the miners don't do the project of work?
Ha! You see, that's the problem. If there's a great number of transactions sitting out there at any moment in time, and there's a fixed number of miners going through it, right? They're going to select the transactions they want because they can process them quickly. They tend to be small pieces, the smaller code, right? The compressible stuff. Your transaction may be one of those. So in the first 10 minutes, it could get scooped up and done. But it may not be one of those. You may have to wait for the next 10 minutes, or the next 10 minutes, or the next 10 minutes. You could be sitting there an hour before your transaction is cleared. That's kind of the answer. The way you get around that is that fee. If you want to guarantee your transaction is in that first batch processed, you jack up the fee. You go to Igor and say, it's not $50, I'll give you $100. Put me to the front of the line. That's what I mean by supply and demand. And it is quoted live online. As I said, you can go and check the price that you're going to have. If you want to guarantee, and they even do it by blocks. If you want to be in the next 1 to 3 blocks, next 3 to 6 blocks, and so forth, you can see scrolling across your page. It's a wonderful world. I wish you could do that in the banking system. Citibank's fees are this now because they're a little slow, but that's not how they do it.
Can Jill buy something with her Bitcoin, a car or a house, or is the Bitcoin the asset that is bought and sold?
Both. It comes back to your question. At some point, you convert the Bitcoin into US dollars because in our economy, you're buying things in US dollars. You're not going to, but having said that, there are people who are willing to sell you a car for Bitcoin. So it's both. Most people, however, would translate their Bitcoin into dollars and go buy the car. But Elon Musk may take Bitcoin for his car. All right. Which one of his cars, I can't tell you. So it's the answer to that question is both. It's not, they're not mutually exclusive.
I just wanted to clarify that you say how it's like you can go home and do this right now, but it is kind of like resource intensive. Yes. And the reward that you do get is fractional of Bitcoin. Like Bitcoin right now is trading for near $60,000 to $70,000 on average. But the reward that you're going to get for like mining or confirming one block is like so fractional to one Bitcoin. It's like 0.000 something something. So it's not. No. And it does require like computational power. Yeah. Which if you don't have, it's going to be more tedious to get the same result.
Yeah. No. Good point. Good point. When it started out, the average person could do this at home. But now you're playing against guys who've got industrial-sized rigs of computers. you're not going to be doing this. But you can watch the transactions. You just can't mine them. I think that's the point that you're trying to make there. You can't participate as a miner and generate for yourself Bitcoin. In the old days, you could.
Where would one go to invest, and which currency might be the one that you would recommend?
Oh, good Lord. I'm not going to get into recommending Bitcoins and whatever. It's just not my bailiwick. All right. What I'm telling you is this. Those markets are thin. The prices are volatile. There is a possibility of market manipulation. So if you're going to play the game, take the risk.
Hi, Peter. You lost me, I think, on the first slide. What's a digital signature? That's the first question. The second one is, where does Jack get his Bitcoin that he's going to give to Jill?
Well,
and where does he keep it while he's waiting to give it to Jill?
a digital signature is simply that piece of computer code that confirms that you have a valid address and that you own the Bitcoin you are claiming to move. And you saw it. It's a bit of gobbledygook. All right, let's just keep it simple. So that's one. Two, you said, ask where Jack got it from. And where did he keep it? He got it by buying it or transferring it or do something that somebody's willing to pay him in Bitcoin for. Just like, something. He may have given them dollars. He may have said, I mowed your lawn. You don't know, okay? But it's for value. Let me put it that way. And he knows it's valid because it's got that digital signature. So he can accept it as payment. So that's that. And where is it stored? It's stored in a computer. It's all in code. There are two kinds of wallets. One is a hard wallet, which is like a, hard drive that you can disconnect from your computer, but it's got all your stuff on it. Or you can just leave it on the hard drive of your computer, but it's basically stored in a computer file. I mean, keep it simple. It's stored in a computer file, right? And it's code within code.
Who are the miners?
Well, it comes back to the point our friend at the back made. Originally, it could have been anybody, but it is narrowed down now to an industry type of thing. People set up corporations, they buy the equipment, they rent the space. So it has become kind of an industrial process. Let me use words that we can understand. So at one point, up until this summer, about 3/4 of all of it was in China. Then the Chinese banned it. So it's migrated somewhat north. That's why I'm using Kazakhstan and places like that as to tease people. But a lot of it's come to the United States. But I think the way to characterize it from our purpose, it's become industrial. These are large companies. BTC on this is a largish organization. So this is industrial is the way to put it, I think. It's the easiest way of putting it. Yes, I'm sorry. Yeah.
You told us repeatedly that this is transparent and we can go on the computer and see all this stuff. To me, it looks like I'd be seeing a bunch of gibberish and I would need volumes or something to figure it out. So if you said, go home and you can watch all this, streaming by. And to me, I'd be like watching, I don't know, a bunch of microbes I can hardly see swimming in a sea.
That's why you need a stiff drink and some popcorn. The point is, the transparency is there in as much as I can see all the transactions. It's the transaction I can see. I just don't know who's doing the transacting. There's a difference, right? That's what I mean by transparency. I can see. Don't forget what we're trying to do. We're trying to discover the provenance of the Bitcoin. I don't care who's giving it to whom. I just need to be able to see that Bitcoin went from that address to this address. And then it went from that address to this address. And then it went from that address to this address. I can follow it. And then I know it's a good Bitcoin. If that particular Bitcoin comes to me, I can say, yes, that's worth it because other people have thought it's worth it. It's an act of faith. Remember what I said about the US dollar, right? It's an act of faith. I just need to see those digital signatures connected together in a long chain. And coming back to your point, the Bitcoin is created by the miners doing the work. So that's where you can actually go all the way back and say, aha, BTC in our case, that particular Bitcoin came from them doing that work. That's how it started its life. That's what I mean by transparency. I don't expect you to understand any of it. The whole purpose is you don't understand any of it. You don't know those addresses. Okay, so it's transparent, but I agree, it's kind of like a false transparency in as much as you can see that there's Bitcoin moving. You can't see why, who, or where. All right. So, well, no, you do see the number of Bitcoin in each transaction. Yep. Yeah. I'm sorry I should have pointed that out. The example I gave to you had the amount of Bitcoin. I'm surprised somebody didn't notice it because the sender sent more than the receiver got. So it was a split transaction. But yeah, you can see the amount of Bitcoin flowing through.
I'm not sure that central banks are as effective as we imagine in managing inflation and employment. But assuming that this is part of their charge, what is the impact of the blockchain supported crypto on that charge and obligation?
We could be here for a while. Short answer is I don't think that the existence of crypto and various blockchain technologies is moving the needle to alter monetary policy at the moment. It's just not big enough. I mean, it has the potential, presumably down the road, but it's not moving the needle right now. So that's, I think if I understood, that's part of that. The reliability of the central bank is the other part of that that question. And would they be reliable bankers in the sense that we think of maybe Citibank as being a reliable banker? Well, given the fact that Citibank has been on the verge of bankruptcy more times than I can remember in my career, I think it probably would. But it's highly debatable. I think the bigger problems with the central bank digital currency is going to become the idea that there is just one bank developing currency and not many banks developing producing currency. And I think that's such a fraught political question. And the lobbyists are already work on it. It doesn't really answer the question, I don't think, but I think it's too complex. We'll talk about it later.
It's you have talked about the libertarian origins of crypto. To what extent do you think new generations who are already transferring crypto payments via Venmo and PayPal will fuel its adoption and therefore expansion?
Well, yes, there's a rapid uptake amongst people who are much more comfortable with digital activities. It comes back, though, more to the fact that can you manufacture enough, or can you move enough, fast enough for it to be a proper money-based system? And that's where I'm skeptical. I'm deeply skeptical about that because I don't think you can scale up blockchain sufficiently to run a large economy. Doesn't mean you can't move transactions easily amongst you, but you can't do your entire life in it. Not yet. Not yet. And as I say, I mean, a lot of this is to be studied. If we look back on the 1990s, who knew Amazon was going to be the survivor? We look back on this period of transition and innovation. Who knows which crypto is going to be the one that survives, and who knows if any of them are going to survive? I think that's what makes it really interesting to come and talk to you about it, because I'll probably be wrong in a year. Okay, there you go. Thank you.